There's a hedge fund in 1998 that had two Nobel Prize winners on its board, Myron Scholes and Robert Merton, the men who literally invented modern financial theory, the Black-Scholes model, the mathematical formula for pricing options and derivatives, the foundation of Wall Street, taught in every business school, used by every major bank. These weren't just smart people, these were the smartest people in finance, and their hedge fund, long-term capital management, lost $4.6 billion in 4 months. Not million, billion. Not because they were reckless, not because they were frauds, because they were too smart. They built mathematical models so sophisticated that they believed they'd eliminated risk. They leveraged those models 31 to 1, $125 billion in positions on $4 billion in equity. And when Russia defaulted in August 1998, every assumption broke. The models failed. Liquidity vanished. LTCM was hours from bankruptcy, but they couldn't be allowed to fail. Because their positions were so interconnected with every major bank, their collapse would trigger a chain reaction. So the Federal Reserve organized a bailout. 14 banks contributing $3.625 billion to prevent the entire financial system from collapsing. But here's what they don't teach you in business school. LTCM wasn't an isolated failure. It was the blueprint for Enron, Lehman Brothers, Archegos in 2021, FTX in 2022, and Silicon Valley Bank in 2023. Every genius failure follows the same 5-stage pattern. Every genius failure begins the same way, with credentials so impressive that no one questions the risks. Long-term capital management was founded in 1994 by John Meriwether, former vice chairman of Salomon Brothers, one of the most successful bond traders in Wall Street history. But Meriwether didn't just bring experience, he assembled the most credentialed team in finance. Myron Scholes, Nobel Prize winner, co-creator of the Black-Scholes model. Robert Merton, Nobel Prize winner, pioneer in continuous time finance. David Mullins, former vice chairman of the Federal Reserve. Eric Rosenfeld, Harvard Business School professor. Larry Hillebrand, MIT PhD in finance. This wasn't a typical hedge fund. This was an academic dream team. The kind of credentials that made investors stop asking questions. Because when Nobel Prize winners are running your money, what questions would you even ask? LTCM raised $1.25 billion in its first round. Minimum investment, $10 million. Investors lined up: banks, pension funds, universities, and wealthy individuals. They weren't investing in a strategy. They were investing in genius. And for 3 years, it worked. 1994, 20% return after fees. 1995, 43% return after fees. 1996, 41% return after fees. Nearly 40% annualized with supposedly low risk. That's stage 1. The credentials. When Nobel Prizes replace due diligence. When intelligence becomes the ultimate marketing tool. LTCM had the best credentials in finance, and that made investors blind to the risks building beneath the surface. Stage 2 is when mathematical theory replaces judgment, when models promise to eliminate risk, when confidence in equations becomes absolute. LTCM's strategy was built on the Black-Scholes model, the same theory for which Scholes won a Nobel Prize. The core assumption: markets are efficient, prices follow predictable patterns, and risk can be managed mathematically. LTCM believed its models could identify riskless arbitrage opportunities, not low risk, riskless, because the math said so. Here's how it worked. LTCM would identify 2 bonds that should trade at similar prices: a 10-year U.S. Treasury and a 10-year corporate bond from a AAA-rated company. The corporate bond should trade at a slightly higher yield to compensate for marginally higher risk. But sometimes market inefficiencies push the spread wider than it should be. LTCM would buy the cheaper bond, short the more expensive one, and wait for the spread to normalize. When it did, they'd close both positions and pocket the difference. The profit on each trade was tiny, maybe 0.1% or 0.2%. But LTCM made hundreds of these trades simultaneously, and they leveraged each trade heavily. Because the model said the risk was minimal. If you're arbitraging two nearly identical assets, the risk of both moving against you is mathematically improbable. So leverage magnifies profit without adding much risk. At least that's what the model said. By 1998, LTCM had $4.72 billion in equity and $125 billion in assets. That's 26.5 to 1 leverage. Include derivatives and off-balance sheet positions, and effective leverage was closer to 31 to 1. For every $1 of their own money, they controlled $31 in assets. The model said this was safe because the positions were market neutral, hedged, and diversified. That's stage 2. When equations replace experience. When the math says it's safe, becomes the answer to every risk question. But models are only as good as their assumptions, and LTCM's assumptions were about to shatter. Stage 3 is when confidence justifies extreme exposure, when leverage multiplies, when safe bets become catastrophic positions. By early 1998, LTCM was running the most leveraged hedge fund in history. $4.72 billion in equity, $125 billion in notional positions, over $1 trillion in derivatives exposure, one fund controlling positions larger than most countries' GDPs. But LTCM's partners believed this was prudent. Every position was hedged. If one trade lost money, the offsetting trade would make money. Net exposure was supposed to be minimal. LTCM's value-at-risk models showed they could lose more than $500 million in a single day only once every few decades. Statistically improbable. So the leverage was justified, but the models missed something critical. Liquidity. LTCM's positions were massive, and many were in less liquid markets. Emerging market bonds, mortgage-backed securities, and interest rate swaps. In normal markets, these positions could be traded easily, but in a crisis, liquidity evaporates. When you need to sell $125 billion worth of positions quickly, there are no buyers. LTCM's models assumed they could always exit at reasonable prices. That assumption only holds when markets function normally. In August 1998, markets stopped functioning normally. Russia defaulted on its debt. Not a small country, a nuclear power, a major emerging market. The default triggered panic. Investors fled to safety. U.S. Treasuries, German bunds, and gold. And the riskless arbitrage spreads LTCM was betting on, they didn't converge. They widened dramatically. Corporate bonds fell while treasuries rose. Spreads that should have been 50 basis points became 200 basis points. LTCM was on the wrong side of hundreds of trades simultaneously, with 31 to 1 leverage. In the first week of September 1998, LTCM lost $500 million. The amount their models said they'd lose once every few decades. It happened in 1 week. Second week, another $500 million gone. Their equity was evaporating. They couldn't exit positions because selling would push prices further against them. That's stage 3, when leverage turns a 5% loss into bankruptcy, when statistically improbable becomes currently happening. Stage 4 is when the impossible happens, when every assumption breaks simultaneously, when mathematical models meet reality. Russia's default was the trigger, but the real problem was deeper. LTCM's models assumed markets are rational, that price movements follow normal distributions, that extreme events are rare and independent. Markets aren't rational in a panic. When Russia defaulted, investors didn't think, time to buy undervalued corporate bonds. They thought, get to safety, now. Everyone ran to the same place, U.S. Treasuries. This created a flight to quality. Treasury prices soared, while everything else crashed. And all of LTCM's arbitrage trades moved in the same direction, against them. The problem with LTCM's diversification was that it wasn't true diversification. They had hundreds of different trades, but every single one relied on the same assumption. Spreads would normalize. When that assumption broke, every trade failed simultaneously. This is called correlation risk. LTCM thought their positions were uncorrelated. In a crisis, correlations go to 1. Everything moves together. With 31-to-1 leverage, small movements become catastrophic. By mid-September 1998, LTCM had lost $4.6 billion. Equity dropped from $4.72 billion to barely $400 million, a 92% loss in 6 weeks. Their counterparties, the banks that had lent them money, were panicking. LTCM owed them billions. If LTCM went bankrupt, those banks would absorb massive losses, which could trigger their own failures, which could trigger other banks' failures. A chain reaction. This is systemic risk. When one institution is so interconnected that its failure threatens the entire system. LTCM had positions with nearly every major bank on Wall Street. Goldman Sachs, Merrill Lynch, JP Morgan, Bear Stearns, Morgan Stanley. If LTCM collapsed, it would force fire sales of billions of dollars in assets, crashing prices further and triggering margin calls on other firms. A death spiral. That's stage 4, the black swan. When the impossible event happens, when models built on historical data fail to predict the future, when genius becomes irrelevant in the face of panic. Stage 5 is the rescue. When the institution is too interconnected to fail, when private profit becomes a public problem. In September 1998, the Federal Reserve Bank of New York convened an emergency meeting, not to bail out LTCM with government money, to organize a private consortium, 14 banks, each contributing $250 to $300 million, total $3.625 billion, to buy out LTCM's partners, stabilize the fund, and prevent disorderly liquidation. This wasn't charity. The banks were protecting themselves. If LTCM collapsed, they'd lose billions. So they paid billions to prevent losing more billions. The Federal Reserve didn't contribute money, but orchestrated the rescue. It used its authority to convene the banks, apply pressure, and make clear that failure wasn't an option. This was the first modern too interconnected to fail bailout. LTCM wasn't too big in terms of assets. $125 billion is large, but not unprecedented. LTCM was too interconnected, too many counterparties, too many overlapping positions, too many potential dominoes. The bailout worked. LTCM was wound down over the following year. Investors lost almost everything. The partners lost their equity and reputations. Scholes and Merton remained respected academics, but their careers in hedge funds were over, and the financial system learned a lesson. Not that leverage is dangerous, not that models can fail, but some institutions are too important to fail, and when they get into trouble, someone will rescue them. That's stage 5, when private risk becomes systemic necessity, when the free market requires intervention to survive. LTCM collapsed in 1998, but the pattern didn't die with it. It has since become the blueprint for every too smart to fail institution. LTCM's pattern has repeated 3 times since 2021. Archegos Capital, March 2021. Stage 1. Bill Huang, former Tiger Management Fund manager, respected on Wall Street for years. Stage 2. Total return swaps, derivative contracts, giving exposure without ownership, sophisticated and opaque. Stage 3. $10 billion equity controlling $50 billion in concentrated positions through 5-to-1 leverage. Stage 4. Viacom CBS dropped 27% in 1 week. Margin calls triggered across his portfolio. Huang couldn't meet them. Stage 5. No government bailout, but Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. The banks absorbed the losses because they had to. FTX. November 2022. Stage 1. Sam Bankman-Fried, MIT physics graduate, genius quantitative trader, effective altruist darling. Stage 2. Crypto arbitrage algorithms, sophisticated risk management, celebrity endorsements. Stage 3. Used customer deposits as collateral, secretly lent billions to his own hedge fund Alameda Research, leverage incalculable. Stage 4. Crypto market crashed. Alameda's collateral became worthless. FTX couldn't meet customer withdrawals. Stage 5. No bailout because crypto wasn't systemically important enough to save. $8 billion in customer funds vanished. SBF arrested, Convicted, sentenced to 25 years. Silicon Valley Bank, March 2023. Stage 1. PhD economists. Industry standard risk models. Sophisticated duration management. Stage 2. Duration risk modeling. Interest rate hedging strategies. Stage 3. Bought long-term treasuries with short-term deposits. Massive duration mismatch. Stage 4. Fed raised rates fastest in 40 years. Bond portfolio lost $15 billion. Depositors withdrew $42 billion in one day. Stage 5. FDIC takeover. Government guaranteed all deposits even above the $250,000 limit. Taxpayers backstopped the losses to prevent contagion. The pattern is identical every time. LTCM. Nobel winners, mathematical models, 31 times leverage, Russia defaults, Fed organized bailout, Archegos, Tiger Alum, derivative swaps, 5 times leverage, stock drops, banks absorb losses. FTX, MIT genius, crypto algorithms, infinite leverage, crypto crashes, arrest. SVB, PhD team, duration models, maturity mismatch, rates rise, government bailout, same 5 stages, different names, every 3 to 5 years. The only variable, whether the institution is systemically important enough to rescue. The lesson from 1998 still applies today. Intelligence doesn't eliminate risk. It just makes you confident in bigger bets. And bigger bets eventually find bigger black swans. If you've watched this far, you understand the genius failure cycle. You see how LTCM in 1998 and FTX in 2022 followed the exact same 5 stages. Subscribe to Capital Origins, because when the next genius fund starts making headlines, when the next Nobel laureate launches a hedge fund, you'll want to know which stage they're in and what historically happens at stage 4. Genius doesn't eliminate risk. It amplifies the catastrophe when things go wrong. Hit subscribe, because LTCM happened over 2 decades ago, but the pattern repeats every 3 to 5 years. And the next genius failure is already forming somewhere. You just need to recognize it before stage 4.